to our first presentation. Alison Felix is Vice President and Denver Branch Executive at the Federal Reserve Bank of Kansas City. In this role, she serves as the bank's regional economist and representative in the states of Colorado, Wyoming, and northern New Mexico. Felix also recruits and works closely with the branch's board of directors and is responsible for briefing the Kansas City Fed's president, a member of the Federal Open Market Committee, on economic and business activity in the Denver region's states. Felix joined the Federal Reserve in 2007 as an economist in the Regional Affairs Department in Kansas City. She was appointed Denver Branch Executive in 2012. She holds a PhD and Master of Arts in economics from the University of Michigan and a BA in mathematics and economics from Kansas State University. Let's welcome Alison Felix to the stage.
Wow, that's really bright. Well, thanks very much. I'm impressed on how many people braved the weather to be here today, and what an impressive venue as well. And I want to thank Tatiana for the invitation to join the Economic Forum today. So today I'm going to talk mostly about what I see going on at the national level, and also what I see going on more locally in Colorado. And I know Tatiana is going to follow up with a more regionally focused economic update. But before I do that, I want to mention just briefly a little bit about where I'm coming from the Federal Reserve System. So the Federal Reserve is obviously the U.S.'s central bank. It was designed back in 1913, and it was the nation's third central bank. The first two central banks of the U.S. were both 20-year charters, and at the end of those 20-year charters, they weren't renewed. And so when it came time to forming the Federal Reserve System, our founders had learned something from those first two central banks, and it was also a pretty grand political compromise. And the compromise came down to, should it be a public institution or a private institution? And should it be centered on the East Coast, where most of the financial centers were, or should it be spread out across the country? And so we see a compromise across both of those fronts. So we have the Board of Governors in Washington, D.C., which is a government entity. It consists of 7 members who are appointed by the president and confirmed by the Senate. But then in addition to that, you have 12 regional Federal Reserve banks spread across the entire U.S. And the presidents of those banks are appointed by their own board of directors. So that's a private institution. And you bring together those two groups, the 12 regional reserve bank presidents and the 7 board of governors members. And those are the individuals that serve on the Federal Open Market Committee, and that's the committee that's charged with conducting the nation's monetary policy. To give a little bit of perspective of where we're coming from the Denver branch of the Federal Reserve Bank of Kansas City, we cover a 7-state region. So of course we're covering the state of Colorado, but also covering the states of Wyoming, northern New Mexico, Nebraska, Kansas, Oklahoma, and western Missouri. And I think you can see by this map here that this was an institution that was designed back in 1913. You can see San Francisco has a massive geography that they're covering, but this was based on economic and trading patterns more than 100 years ago, and of course the nation looks much different today. Today I'm going to focus my comments really on the top mission of the Federal Reserve that's here, which is conducting the nation's monetary policy. And within that mission, the committee has a statutory mandate from Congress to promote maximum employment, stable prices, and moderate long-term interest rates. But in addition to monetary policy, the Federal Reserve is also actively involved in the nation's payment system and is also charged with supervising and regulating banking operations. So let me turn now to talk about what I see going on in the national economy. So this first chart here shows US GDP growth over the last 10 years. And what's particularly notable about our current time period is that we're currently in the longest expansion in US history. So the data on this go back to 1850, and we're sitting right in the middle of the longest expansion. That said, growth during this time period has been fairly moderate. So on an annualized basis, growth has been averaging about 2% per year during this entire 10-year time frame, We did see growth pick up a bit in 2018. It was closer to 3% growth, really boosted by solid consumer spending. But if you think back to the beginning of 2018, also boosted by the tax policy change that we saw. So we saw those changes in tax policies really boost both consumer spending, but also business investment. And that's a boost that we expect to really moderate moving into 2019. So if you look at the gray bars on the far right-hand side, the darker portion of those bars are the range of forecasts coming from the Federal Open Market Committee. The committee is expecting growth this year somewhere between 2.1 and 2.3%. That's a pretty healthy pace of growth for the US economy. It's a little bit above what we would consider to be a trend rate of growth, and so that's still pretty good news for the US. Some of the biggest positives in the US economy right now, probably the biggest one, is a very strong labor market. The unemployment rate currently sits at 3.5%, which is the lowest unemployment rate in the US for the last 50 years. So we have very tight labor markets. It's great news for students that are graduating this year. The unemployment rate looks very healthy. In addition to that, over the past 3 months, we've added 157,000 jobs per month on average. That's a slower pace of job expansion than we saw in 2017 and 2018, but over time we expect that number to come down as the labor market gets tighter and tighter. So to put that number into perspective and kind of think about, is that a good number or not so good? Each month in the US economy, we add somewhere between 90,000 and 100,000 new entrants into the labor force. So anytime we're adding more jobs than that 100,000 mark, we're doing pretty well. We're bringing down unemployment rates and we're helping to attract people into the labor force. And so that 157,000 number is really a pretty strong number. With a very strong labor market, we're also seeing that consumer spending really remains solid. And that's really crucially important for the US economy. Consumer spending makes up about 70% of the US economy. So anytime consumers are feeling fairly confident, anytime they're out there spending money, the US economy is probably doing quite well. So all in all, the baseline forecast for the US economy is quite positive. That said, really over the last year, the risks to that outlook have started to tilt to the downside. And I think that's really where you hear a lot of media coverage more recently, is looking at some of these downside risks to the outlook. And from my viewpoint, a lot of those risks are not really domestic risks, but instead global risks. So when you look at the global economy, we're starting to see many countries with weaker economies. And I'll talk a little bit more about that later, but you see countries like Germany maybe on the verge of recession. You have some uncertainties related to Brexit and how that might unfold. China's economy is slowing. Certainly we have a lot of uncertainty as it relates to trade policy. And the dollar has appreciated quite substantially as the US has been one of the strongest performers around the globe. And that's gonna make it harder on the companies in the US that are trying to compete on a global scale. So I think that's really one of the key risks to the outlook. In addition to that, we're seeing some signs of slowing on the US side of things as well. We're seeing a little bit of a slowdown in manufacturing, a little bit of a slowdown in residential construction activity as well. But I'll talk more about that as we go on. So I mentioned the importance of consumer spending being 70% of the US economy, and this chart here shows both retail sales and also personal consumption expenditures. And you can see by both of these measures, consumer spending really continues to expand at a pretty solid pace. In particular, July was a very strong month for retail sales. As many of you probably know, Amazon chooses to hold their Prime Day event in July, and that actually shows up in the data. Retail sales are pretty strong in July, not just from Amazon. There are lots of other competitors that have promotions during that same time period. But you can see, all in all, consumer spending continues to increase. And as we look at thinking about a forecast for the US economy, one of the reasons that so many economists believe that growth will continue, it's really because of the consumer. The consumer looks like they're in a pretty good position to continue to spend. Part of that is that unemployment rates are very low. So most people who want a job have a job. And not only that, but we're starting to see wages pick up at a little bit faster pace. In addition, savings rates have moved up since the recession started. So if you look back at 2007, savings rates in the US were closer to 2%. Today, they're at 8.1%. So consumers have a little bit more cushion. So should the economy start to dip down, there's some cushion there for consumers. And although debt levels continue to rise for households, the amount that households need to pay to service those debts on a monthly basis is at historically low levels. A lot of consumers took the low interest rate environment and refinanced their mortgages, and so what they're paying on a monthly basis has come down. And so they look pretty capable of continuing to increase their spending levels. So we're expecting the consumer to continue to do quite well, but there are a few risks. One of the risks to that outlook is what we term wealth effects. So a lot of consumers, as their wealth goes up, they tend to spend more, even though it's not actually money in your pocket. And when you think of wealth in the US economy, for most individuals, that means their home, if they own their own home, or it might mean owning stocks. Now, certainly this isn't all individuals in the US economy, but for many people, that's where their wealth stems from. But what we're seeing on a national basis is we're seeing a lot of stock market volatility. We haven't seen a big correction yet, but certainly I think there's some risks that the stock market could fall. That might have some impact on consumers. In addition, we're seeing home price appreciation start to slow, and we're starting to see that in Colorado as well. So that might mean that consumers are spending a little bit less money. I think the other big factor for consumers is consumer confidence. So on this next chart, if you look at the pink line here, this is consumer sentiment. So this is a monthly survey asking consumers how do they feel about both their own financial situation, how do they feel about their job, but also how they feel about the US economy. And you can see that over the long run, this number still remains at fairly high levels historically, which is good news. It points to a consumer that feels pretty good about conditions, probably willing to spend, and so that kind of is in line with the baseline forecast. At the same time, you can see over the last couple of months that confidence level has come down, with about a third of respondents citing the trade war as the reason for the decline in their confidence over the past month. I think in addition to that, we tend to see this index move a little bit with the stock market, so with that volatility, that's likely also putting some downward pressure there. So I think overall, this is a pretty strong number. But if we should start to see this number come down farther, that'd be something that we would watch carefully because that could indicate that spending might start to falter a little bit. The other thing that I've shown on this chart is business optimism, and in particular, small business optimism. And you can see that by that level, it's also at fairly high levels historically. Also below year-ago levels, so I think the trade uncertainty, some of the weakness that we're starting to see in the economy is starting to trickle into these optimism indices, but overall, still looking pretty positive. From the Federal Reserve's standpoint, we have a dual mandate, both to promote maximum employment and price stability. So on the maximum employment side of things, one way to look at that is to look at the unemployment rate. And this shows the unemployment rate for the US. And you can see here that the unemployment rate has been really gradually declining over the last 9 years, currently sitting at 3.5%, which, as I mentioned, is the lowest level since December 1969. In addition, what you might notice is that the current level is sitting below a horizontal line that I've put on the chart. And that represents the median of the FOMC's longer run projections for the unemployment rate. So something that most economists consider to be the natural rate of unemployment, or where unemployment might end up in the longer term. And so you can see that the current unemployment rate in the US is sitting below that median projection, which is at 4.2%. And really all that indicates is that we're in a very tight labor market environment. When I go out and talk to business leaders across Colorado, usually their number one concern is that they can't find workers to fill open positions. Maybe there are workers out there, but there's a skills mismatch, and in many cases, there just aren't a lot of applicants for job openings. Turning to look at the other side of the dual mandate for the Federal Reserve, this slide shows two different measures of inflation. The pink line shows headline inflation, and so that's gonna pick up the prices of all goods and services purchased either by consumers or on behalf of consumers. And by that measure, prices are up 1.4% over the past year. The blue line shows core inflation. It subtracts out the most volatile components of inflation, which tend to be food and energy prices. And by that measure, prices are up 1.8% compared to a year ago. So you can see that by both of these measures of inflation, prices are moving up at a pace below the Federal Reserve's 2% target. So you hear a lot of committee members talking about they'd like to see that inflation rate move up a little bit higher, but still it's fairly near the target overall. So given that the labor market looks very healthy, given that inflation is near target, but a little bit below, what has the Federal Reserve been doing? So this slide here shows the effective federal funds rate, which is really what we think of as traditional monetary policy. So you can see that during the entire recession, the federal funds rate was sitting at the zero lower bound. So they'd effectively lowered interest rates as far as they could lower them without going into negative territory. And then starting back in December 2015, the committee started to gradually increase the federal funds rate. So as economic conditions looked healthier and healthier, they started to move up this federal funds rate. What's changed in 2019 is that they've actually lowered the federal funds rate 2 times so far this year. And as you look at conditions, you look at and you say, well, labor markets are fairly healthy. It looks like that mandate is being met. Inflation, it's not at 2. So one argument is that you want to see inflation a little bit higher, but it's close. And so you hear a lot of committee members talking about looking at all of the uncertainty that's out there, not just in the US economy, but also globally, and perhaps using that cut as a bit of insurance against a possible future downturn. Really trying to make sure that the US economy continues to expand, even as there's a little bit of uncertainty in the economy. I will note that the president of the Federal Reserve Bank of Kansas City, Esther George, is a voting member on the Federal Open Market Committee this year, and she has dissented against these 2 cuts. So she preferred that the federal funds rate should stay steady. So not a decline, not an increase, but also not a decline. And she really views that. She has statements out that we're doing fairly well as it relates to the dual mandate. We do have a labor market that's very close to maximum employment, if not past maximum employment. And we have an inflation rate that's sitting very near 2%. The other piece that I wanted to briefly mention about Federal Reserve policy is the Federal Reserve's balance sheet. And this is something that, you know, if we'd looked at this 10, 15 years ago, this would have been kind of a non-issue. Nobody really looked at the Federal Reserve's balance sheet. But during the recent recession, when the federal funds rate got down to that zero lower bound, the economy was still in pretty bad shape. And so the Federal Reserve started looking for additional tools. What else can we do to stimulate growth in the US economy? And what they decided to do is conduct 3 different rounds of what they termed quantitative easing. So essentially buying treasury securities or mortgage-backed securities. And so you can see that the balance sheet of the Federal Reserve increased from a little bit under $900 billion back in 2008 to a peak of $4.5 trillion. And really the goal of these policies was very similar to what you would get from lowering the federal funds rate, really to put some downward pressure on longer term interest rates and to spur investment in the US economy. Starting back in October of 2017, you can see that the balance sheet starts to gradually decline. The committee decided to let some of the assets start to mature off of its balance sheet. They stopped that roll-off in August of this year, and so now the balance sheet's being held fairly steady at $3.8 trillion. So this time I want to take a step back and pull into the picture the Colorado economy overall. And I've put Colorado Springs into most of these, but I won't talk too much about Colorado Springs because I'll make sure that Tatiana is covering that piece. But here you can see payroll employment growth since the recession started back in December 2007. And I think one of the things that really stands out here is the strong performance of the Colorado economy. Both the US and the Colorado economy have been adding jobs now for over 9 years, but you can see that the pace of job gains in Colorado has been about twice as fast as what we've seen at the national level. Just looking over the past year, you can see employment increased 2.4% in the state of Colorado versus 1.4% growth at the national level. One thing you also notice if you look at Colorado Springs here is that Colorado Springs, the recovery there lagged kind of the Denver metro for the first few years of the recovery. So you can see between the end of 2009 to 2013, Colorado Springs was certainly growing. They were growing at about the same pace as the nation. But really after that, growth really started to take off in Colorado Springs. And it's been very strong over the past year, employment up 3.4% here locally. Looking across industries, this shows employment growth by industry over the past year, and Colorado is shown in the blue bars. I think the main takeaway from this slide is that job gains have been pretty broad-based across industries. So you can see at the top that professional and business services have added a lot of jobs over the past year. I think that's particularly good news for the state of Colorado. That tends to be a high-paying industry where we want to see those jobs expand in the state. But you also have most other industries adding jobs as well. And so why that's good news is that if the economy starts to slow a little bit, which we're seeing, I think, both here locally and seeing at the national level, if any one industry starts to falter, there are many others that are adding jobs, and that's a good sign. There's really only 2 industries that lost jobs in Colorado over the past year. One is the information sector, which is going to be primarily telecommunications, but also to some extent includes newspapers, broadcasting, so we've seen some weakness there, and also the financial services sector. So we've seen banks have some large mergers in the Colorado area, and that's resulted in some job losses. Turning to look at unemployment rates more locally. So I mentioned that at the national level, the unemployment rate is very low, and we're seeing even lower unemployment rates, both in Colorado and in Colorado Springs. So in Colorado, overall, the unemployment rate is currently 2.8%. To give that number some perspective, if you went back to 1980 and looked at the average unemployment rate in Colorado since then, that would be 5.3%. So we're at about half of where we are on average historically. So we have very tight unemployment rates across most of Colorado. And you can see there in Colorado Springs, the unemployment rate currently 3.3%, also a very low rate. For both Colorado and Colorado Springs, these are the lowest unemployment rates that we've seen going back to the early 2000s. So these are lower than what we were seeing in the 2006, 2007 kind of strong years there. If you remember back to the very late 1990s, early 2000s, when the tech boom was in Colorado, that's where we're sitting right now. We're sitting at that low level of unemployment. Another thing that I wanted to mention is population growth in Colorado. And I think in a lot of areas this might not be such a big deal, but in Colorado I really think it is, because we continue to attract a lot of people to our state. So this shows 2 things. It shows births and deaths in the blue bars, and it shows net migration in the pink bars. And you can see in the gray, which is the year-over-year % change in population growth, that population growth has slowed by about half since the early 1990s. So we were growing about 3% a year. Today we're growing about 1.5% per year. A lot of that is just a slower birth rate. And that's true not just in Colorado, but also nationally. But when you look at those migration numbers, in terms of the level of migration, it's really remained very similar. We saw very strong migration in the 1990s. On average, during the 1990s, we were adding about 54,000 people per year to the state of Colorado. Last year, we added 51,000 people to Colorado. So very similar in terms of overall level. For the state as a whole, net migration added 0.9% to Colorado's population last year. Colorado, in El Paso County, even a little bit stronger. Population increased 1.1% just due to net migration, so not including births. So now I want to take a look at several different sectors in the Colorado economy and nationally, and kind of starting with the positive. So this is, I think, the big positive, and you see this show up on the jobs front as well. So these are 2 different surveys, but both surveying services firms. So this could be anything from healthcare services to professional and business services to high-tech industry, real estate, all of that falls into this category. And anything here above 50 indicates that the sector is expanding. And you can see that at both the national level and at the local level, the services sector continues to expand at a pretty moderate pace. So we're seeing pretty healthy gains there. That's really where most of the growth in the US economy is coming from. So good news on that front. Where we're starting to see some slowdown is on the manufacturing side of things. So these, again, very similar surveys, but this time of manufacturers. And you can see that we saw very strong growth in 2018 in the manufacturing sector. But since then, these indices have just gradually ticked down. So first we were seeing slower growth, and then over the last couple of months, both at the national level and at the regional level, this number has fallen below 50, indicating that the manufacturing sector is now contracting slightly. I think there's a lot of things that you can attribute to that. I think a lot of it is weaker global economies, the strong dollar, and trade uncertainty are all making it very difficult for manufacturing firms to compete on a global scale. And so particularly for firms that are in that arena, we're starting to see some slowdown. Another area where we're seeing some slowdown is in residential construction activity. So if you look primarily at the right-hand chart, that shows residential permitting activity in Colorado as a whole. And you can see some pretty strong expansion over the last several years through 2018. But starting in 2019, we're starting to see a slowdown. Single-family permits are down 8%, multifamily permits are down 16%. So pretty significant. We're seeing a faster slowdown here than we're seeing at the national level. The multifamily side, perhaps not too surprising. We saw a huge ramp up in multifamily building in the preceding years. And so there's still a lot of apartments that I think contractors are waiting to see if those will completely fill up. So far, vacancy rates are pretty level. But on the single family side of things, I think maybe a little bit of a surprise given how low single family inventories still are today. I think a lot of that can be attributed to just very high construction cost, high land cost, construction labor is in short supply. So all of that I think is playing a role there, but we are seeing some slowdown in residential construction. Home prices, however, continue to accelerate. So we still, I shouldn't say accelerate, continue to expand. The month's supply of homes in Colorado is currently 2.7 months. We consider a balanced market to be somewhere between 5 to 6 months, so definitely still a seller's market in Colorado. In Colorado Springs, inventory is much tighter, only a 1.4 month supply of homes on the market in Colorado Springs. And so anytime you have very low inventories, you'd expect prices to go up, and we're continuing to see that. So overall prices in Colorado up 5.4% over the past year. For the state as a whole, and I think particularly in the Denver metro area, we're starting to see home prices start to moderate a little bit. So in Denver, they've fallen from double-digit gains to about 3% annual growth. Inventories still remain low across the state, so I think prices are unlikely to see a sharp correction just because inventories are so low, but certainly something to watch. Something else that I wanted to mention related to residential construction and homes is just the cost of houses in Colorado. As we all know, home prices have been going up pretty substantially over the last several years, and that's putting a big burden on some households in our state. So currently 24% of renters and 9% of homeowners are spending more than 50% of their household income on housing. So that's a pretty significant share, and I think something to put in perspective when you're thinking about other industries, particularly related to consumer spending. If you're spending more than 50% of your household budget on housing, that certainly leaves less for other types of spending. Turning now to look directly at the global economy, I've shown several different countries here, but I think the key takeaway is that most countries across the world are expecting a slowdown this year in growth. In particular, earlier I noted that Germany is expecting about half the growth this year that they saw last year. The UK is expecting a decline, and I think a lot of unknowns related to Brexit. And then China is expecting growth to slow for several years in a row here into the future. With that slower global growth, and also with some trade uncertainty, exports in Colorado are starting to decline. So exports this year in Colorado down about 6% from where they were a year ago. Turning to look at the energy sector in Colorado, this remains a key sector for the state. Oil production overall remains fairly high in the state of Colorado. It's still near its record levels. Productivity in the sector, technology in the sector has improved drastically over the last 10 years. But when we look at the outlook for the sector, oil prices are below where they were a year ago. They've been pretty volatile through this summer. They're currently sitting around $53, $54 per barrel, We asked contacts in our region, what is your break even for oil? And they report needing about $52 per barrel. So we're sitting right above break even levels. So firms in our region are doing okay. But when you ask them what they're expecting over the next 6 months, they're not as optimistic as they were a year ago, given that prices are quite a bit lower. So they're expecting employment to hold stable over the next 6 months, but they're expecting to pull back a little bit on drilling activity. We're already starting to see that in Colorado, and they're expecting profits to be a little bit weaker than they were a year ago. So I don't think energy is a big drag on the Colorado economy, but certainly not adding as much to growth as they were last year and in 2017. And then the last sector that I wanted to just briefly touch on is the agriculture sector. This is a sector that has been weak for quite some time, and I think when you look both at Colorado and you look at the nation overall, this has probably been the weakest sector over the last 3 or 4 years, really. As the Colorado economy was booming during this time period, agriculture was weak. Crop prices and livestock prices were fairly low. We're starting to see a little bit of improvement on the livestock side of things, but overall, the USDA is expecting net farm income to remain relatively weak in 2019. So I'm going to stop there. Overall, I think the outlook for both the US economy and the Colorado economy is pretty solid. We're expecting a little bit above trend growth at the national level, and I think Colorado is in even a better position. Colorado has been outperforming the nation for quite some time. They look like they're continuing to do that in 2019, pretty broad-based growth across sectors, and so I think that's all a real positive for the state. We continue to attract a lot of people to the region, which I know causes some concern as it relates to housing prices and traffic, but I think overall has been a good thing on net for the state. But we are starting to see some signs of slowing, and in particular, looking at things like manufacturing, residential construction activity, exports, all of those things are having some downward pressure on how quickly we're growing, both as a state and as a nation. And so those are things that we're watching carefully, and in particular, watching how the consumer responds to those events. It looks like the consumer may hold up well, and if so, I think the US economy will continue to do well into the future. So I will stop there, and I think maybe we have a few minutes for questions.
Test, there we go. We do have some time. We're gonna open up to questions so that Allison can get back to Denver. So if you do have questions, you can be using that hashtag #EconForum, and then the ushers are also going to have cards for you to write your questions on it as well. Thank you very much, Allison. Let's give Allison a round of applause. So one of the first questions that we got ahead of time had to do with education. So what is higher education doing, and what can it do to pivot towards the high demand occupations, especially those that have more recently emerged, like software engineers and coders?
Yeah, I mean, I think it's a great question. I think businesses are really looking to institutions of higher education to help fill some of these labor shortages. I think right now in particular, there are a lot of firms looking for specific skill sets that they're just not finding. And so I think over time, really in particular over the last 5 to 10 years, higher education has become has really partnered more with higher education to put together programs that are not just great for students, but are also great for businesses. So whether that's linking through internships, providing the technology to maybe use on-site, on campus to help prepare students directly for those jobs, I think will be crucially important. And I think a lot of higher education institutions are really learning how to adapt more quickly to the changing job environment. It does look like the US economy is changing at a faster pace. We're seeing a lot of new careers develop quickly, and I think that that's been a shift in education overall to how to change quickly.
Probably the question that's on many people's minds, as it is every single year, and especially as business owners who are trying to prepare. When do you think a downturn or recession will occur? Pull out your crystal ball. What might be a major trigger of it? And how do you think it will impact Colorado specifically?
Yeah, so I wish I had the answer to that question. I don't. But certainly I think not just economists, but businesses and the general public are all starting to look at the US economy and say, when is this recession coming? I think a lot of that conversation is occurring just because of the sheer length of this expansionary period. Knowing that it's in the longest stretch in US history, I think is causing some concern. But as I'm sure you've all heard, most economists don't think that expansions die of old age. So that alone, I don't think will end the expansion. So maybe I'll quote from, I was recently at a conference of the National Association of Business Economists, and they surveyed their membership, and about 47% thought a recession would come by the end of 2020, but 53% thought it would be later than that. And so I think a very mixed view of when a recession might be coming. Again, I think the baseline's pretty healthy right now. In terms of how Colorado might fare in that, usually, that depends on which sectors take a hit. And so if you remember back to the tech bust in the early 2000s, that hit Colorado particularly hard, much harder here than in the nation overall. The most recent recession looked very similar in Colorado to other areas, and we bounced back even faster because we didn't have a huge excess housing supply. So, looking at what's coming down the road, it's really hard to project where it might be coming from. For me personally, you start to see some slowing signs, but where we haven't seen that is on the consumer side. And so that's something that I'm watching carefully, is how the consumer responds to everything else that's going on, whether it's global events or whether it's a correction in the stock market. So I think that's, stock prices are fairly elevated right now, and how might the consumer respond if those prices come down? And so then looking at Colorado's economy, I think in one sense we're fairly well positioned because we have a lot of people moving into the region. We have a fairly highly educated population. Our income levels are fairly high. All of those things would fare fairly well if consumer spending starts to take a hit. Where we might see some challenges is that for a state as a whole, we're pretty highly reliant on tourism. And so if consumer spending pulls back, that sector could certainly take a hit over time.
Okay. If anyone's writing in any questions, we are going to have one more question, so get your note cards and questions in. What last piece of advice might you have for Colorado Springs business owners when they're looking at their strategy for the rest of this year and into 2020?
Sure. I think it's a great time to be in Colorado Springs. You can see from the charts, and I'm sure later you'll see even more, that growth in Colorado Springs has really taken off over the last couple of years. And I think to really embrace that, I think Colorado Springs not only has a strong history of being a good community, but they're really starting to attract a lot of people to the region. So I think one thing that will be crucial is how to deal with all of that growth. So how to attract new businesses, new people, and work together as a community to grow in a way that everybody feels that it still represents the community, and that you can expand but still have people not complaining about increased traffic and high housing costs, which I think maybe Denver hasn't done a great job at. So maybe you can learn from Denver and expand at a very healthy rate that looks solid. I think one other thing that, for Colorado Springs and for everywhere, but every city I think is challenged with their own industry diversification. So, as you look at cities and how they might weather future downturns, I think always having an eye to say, which industries are really heavy in the region, what are some of the areas that could get hit, what might that look like, and if that does happen, kind of where can some of those jobs, where can some of those workers shift to, where can they transition to until some of those key industries come back.
All right, I see one card coming up that we'll have as our last question. Yes, I'm talking to you, Usher, on stage left. Is that a question for Alison? All right, let's grab that. This is a big stage to walk across. How do I look? Coming all the way back.
Okay.
Okay, we talk about being at full employment. What about the poor workforce participation rate? and let's be sure to define workforce participation rates as well.
Sure.
It is, according to this, around 63%, fact check.
I don't have the exact number, but sure.
Okay. That's correct. We have Tatiana confirming. How can we get more of the 37% of working age Americans to get a job?
Yeah, so
I can guess who asked this question in the audience right now.
So first I'll say it's not quite that bad. But yeah, so the way that they're measuring the labor force participation rate is looking at individuals 16 and over. Everybody 16 and over. And so some of the reasons that we're not at 100% is because hopefully the 16 to 21-year-olds might be in school. And so that's put some downward pressure on labor force participation rates over time as people stay in school longer and maybe hold off on getting a job longer. The other big downward push that we've seen really over the last decade has been as the baby boomers start to retire. And everybody knows we have a huge baby boom population. They're starting to enter retirement, and as they retire, that's putting some downward pressure on labor force participation rates as well. But the other thing that we saw during the recession that's not a long-run trend, but more of a business cycle trend, is that as unemployment rates went up pretty dramatically during the recession, we did see individuals drop out of the labor force. So essentially, you're only counted as part of the labor force if you're either employed or you're unemployed and actively looking for work. So if you're unemployed and you're not looking for a job, then you're not in the labor force. And so I think it's a good question to say, how do we get some of the people that aren't actively looking for work, but are of prime working age, who have these skills that we would love to see in the labor market, how do we get those individuals to start to come back in? And so we've seen, I would say, a little bit of that already in the US economy. And in particular, we've seen quite a bit of that in the Colorado economy, particularly for Colorado, really between 2016 to 2018, we saw our labor force participation rate actually increase pretty significantly, which is really good to see. At the national level, really we're seeing enough people enter the labor force to really offset those that are retiring, so it's been kind of flat in recent years. And so it has been encouraging to see some people come back in to the labor force. And so I think that's one of the reasons why you see the Federal Open Market Committee willing to leave rates so low and perhaps even decrease rates this year, is because we are seeing some improvement in terms of an increase in labor force participation rate. We're also seeing wages start to go up a little bit more, particularly on that low skill side of the workforce, which is really encouraging to see as well. But in terms of how do we get even more of those individuals to come in, I think, I think it's several things. I mean, I think that there's all kinds of factors that keep people out of the workforce. I think the one that maybe is not easy to solve, but easier to solve could be training. Making sure that individuals that aren't in the workforce have the training that they need to get a good job. And I think if you left the labor force back in 2008 at the heart of the recession, and you haven't been in the labor force for 10 years, your skills have probably deteriorated, and the skills that you need to re-enter the labor force have probably changed a bit. And so I think making sure that access to gain those skills is available is one of those key barriers to coming back in. I think for a lot of families too, particularly on the lower income side of the scale, things like access to transportation, access to childcare, those types of things I think make a difference in getting people back into the workforce. And to some extent, we see some of the increase in the workforce that we've already seen. People tend to be attracted to come back in when wages are going up at a higher pace. So when you start to see those entry-level wages at higher levels, I think individuals start to see some of that and think, well, maybe I'll put my resume out there. It might be worth kind of re-entering the labor force. So I think that there are several things to look at there. I think most economists don't expect a huge increase in labor force participation rates in the coming years. Certainly it would be great to see a lot of people come back into the labor force, but I think, and looking at where we are today, I think we've seen a lot of the gains that I think we're expecting to see in terms of people coming back in. But thanks, great question.
During that answer, you had the entire row of the Pikes Peak Workforce Center nodding and agreeing with a lot of the statements you made, getting people back to work.
Great.
Final question here. Can you review what factors led to the last recession, and will some of those same indicators hint us for the next one?
Wow, that could take a while. The last recession was obviously a severe recession, and not just a severe recession, but also a financial crisis in the US and globally. So I don't know that we can really, or I mean, perhaps I'm not an expert in order to tell you everything that led to the last recession. Certainly, housing was one area that was overbuilt in many parts of the country. But not just the fact that it was overbuilt, but it was the way it was financed. It was a lot of maybe second homes or investment homes or trying to flip homes. And so that ended up being a much bigger crisis than was anticipated by the vast majority of economists. And so when that sector started to fall, it rippled through other parts of the economy, including the financial sector. And so those interrelations really played a big role in the last crisis. So I think part of it was housing. Part of it was the financial sector. And so maybe just concentrating on those two things. On the housing side of things, this time around, in my view, looks quite a bit healthier than last time. That being said, again, not very many economists noted it last time in 2006, so we'll see if we get it wrong this time. But it looks healthier. I mean, looking at Colorado, we have a very low inventory of homes. We have had the run-up in prices here locally, but the low inventory would point to something different. I think, the quality of mortgages looks healthier this time around, so we don't see quite the same easy financing that we saw back in 2005 and 2006. And so that looks like we're in better shape there. Looking locally, if you were looking on kind of the housing side of things, where you might see extra building is on the multifamily side of things, which was not necessarily the case last time. And so that's something we've been watching, but we haven't seen a huge uptick in vacancy rates at this point locally. Looking at the financial sector, I think in general firms look better. Bank earnings are fairly high. Capital levels are higher than they were. And so I think there are several measures that would point to a sector that looks healthier than it did before. Doesn't mean that there aren't any risks. I think that there are several areas that people are watching. I think one of the concerns that many members of the committee have when you have interest rates that are as low as they have been for quite some time, you're not earning a whole lot if you're putting your money in a bank. And so there's been kind of a reach for yield activity. And so you find investors reaching into things like the stock market or to junk bonds or to corporate debt or these other asset classes. And so, you might see some build up in some of those classes that could lead to some corrections in some areas. But I don't think that there's any area that jumps out right now as being particularly, that may cause the next recession.
Alison, thank you so much for being here. Let's give it up for Alison Felix.